Right now, the data surrounding the Shiba Inu token presents a severe anomaly. The market is tearing itself in two completely opposite directions. On one side, we are seeing aggressive on-chain accumulation. On the other, the technical price action remains relentlessly bearish. The bullish case hinges on a massive supply shock. Average exchange outflows for Shib have spiked by 126% in a matter of weeks. Yet, despite that rapid exit of tokens, the technical reality paints a different picture. The asset continues to form a strict pattern of lower lows on the price chart. This contradiction forces analysts into a difficult position. We have to weigh highly positive liquidity metrics against lagging but dominant technical indicators. The central analytical question here is a mechanical one. Why does an asset's price continue to drop if its circulating supply on exchanges is actively being removed? To answer that, we rely on a framework known as indicator divergence. We will evaluate this by comparing two distinct datasets. First, we will measure Shib's exact liquidity profile. Then, we will map that against its overlapping exponential moving averages. What this data reveals is that on-chain metrics frequently act as premature signals of accumulation. They are entirely invalid without structural price realization. Understanding the mechanical lag between these two datasets is essential for objective, accurate market analysis. Let's begin by dissecting the on-chain accumulation profile to see exactly what investors are doing with their tokens. The key metric here is exchange net flow. In mechanical terms, net flow is simply the difference between the number of tokens entering exchange wallets to be traded and the number leaving for private custody. Recently, Shib recorded a heavily negative net flow, specifically a net loss of 23.2 billion tokens from trading platforms. That migration resulted in shrinking total exchange reserves by 0.03%. The behavioral implication of this is clear. Moving tokens off an exchange and into cold storage signals that owners intend to hold their positions long-term rather than actively trade them. This introduces the concept of sell-side liquidity. By physically removing 23.2 billion tokens from exchanges, these holders are directly thinning out the available order book. Negative net flow structurally limits immediate downward sell pressure. It removes the available ammunition from the market. To measure the velocity of this accumulation, we pivot to the 7-day average exchange outflow metric. This chart tracks the historical rate of Shib withdrawals, culminating in a 126% vertical spike compared to recent weeks. Quantitative analysts look for these sudden velocity spikes because they represent a sharp, measurable increase in holding conviction among current investors. However, there is a strict difference between holding conviction, which is existing owners refusing to sell, and active buying pressure, which requires new capital to enter the market. Reducing available supply does not inherently equate to increased demand. We can see this disconnect clearly by analyzing short-term network activity alongside price volatility. After several weeks of entirely flat, stable trading, larger short-term price moves are finally returning to the asset. Concurrently, active addresses have increased by over 1%. Sidelined market participants are waking up and reacting to this new volatility. This dual-axis graph compares rising network participation against momentum. On top is the upward trend in active addresses. On the bottom, we plot the relative strength index. A sustained RSI reading near 40 proves that while selling pressure has subsided, bullish momentum is completely absent. An increase in trading volume without a corresponding rise in the RSI means the market lacks directional buy-side conviction. So why is the on-chain data failing to move the market? We find the answer in the technical price charts. The macro market structure for Shib is strictly bearish. It continues to carve out a persistent pattern of lower highs and lower lows. This candlestick chart establishes the asset's current baseline trading price at approximately 0.0000413. Above this price sit exponential moving averages, or EMAs, which act as dynamic friction zones suppressing upward movement. The immediate short-term hurdles are dense. We have the 20-day EMA at 0.0000420 and the 50-day EMA sitting right above it at 0.0000426. Zooming out reveals the macro hurdles. the 100-day EMA at 0.0000443, and the 200-day EMA at 0.0000447. This cascading cluster of lagging indicators effectively traps the asset. It creates a ceiling so incredibly heavy that it entirely nullifies the benefits of the on-chain supply reduction. Placing these two conflicting frameworks side by side yields a clear evaluation. The positive reality is that current holders have demonstrated structural conviction through high-volume exchange outflows. The negative reality is that buyers have utterly failed to translate that illiquidity into upward price action. The specific technical prerequisite for a trend reversal requires buyers to actively reclaim the heavy resistance zone spanning from 0.0000430 to 0.0000445. Until that defined numerical zone is breached, the technical reality overrules the on-chain optimism. Returning to the macro perspective of quantitative market analysis provides our final verdict. That 126% outflow spike is definitively a premature signal. On-chain accumulation is a necessary condition for a market rally, but it is an entirely insufficient one on its own. Sophisticated analysts do not deploy capital purely on leading liquidity indicators. They wait for technical confirmation. In market microstructure, illiquidity without active price realization is just latent potential, and certainly not a guaranteed market reversal.